Hello, my name is Brett Pierce. I'm the president of the retail division for CountryPlace Mortgage. CountryPlace Mortgage is a full-service mortgage lender. We have offices across the United States, and we specialize in construction financing for both manufactured and modular homes. I wanted to take a moment today to talk a little bit about our construction loan product. These products typically can be confusing, and many people are uninformed about how a construction loan works. If you're purchasing land, raw land, and you're planning to build on it, or you're installing a manufactured or modular home on property that you already own, then this is probably the right product for you. The reason that you want a construction loan is it allows you to close the loan before any work starts on the property. All the funds are put aside in escrow and then paid out in draws as the project gets going. During the construction period, you make interest-only payments on only the amount of money that you've drawn or put to work. Typically, your interest payments are a little lower up front in the project, and then they gradually increase as you draw more money out of the construction loan. Most builders aren't going to go build on your property without some assurances that there's a loan in place so they can get paid once the home is built or complete. A construction loan ensures that funds are available so the builder can get paid once they get done. Your only other option would be really to have the builder go complete the project, go build the home or install the manufactured home or the modular home on your property, and then you would go close the loan and pay everybody off. Well, the risk here is that if somebody got hurt, lost a job during that construction period, and now they didn't qualify for the permanent loan, well, the builder's got a home built on your property, and now they've got a real mess because there's no way to pay for it. Basically, construction loans eliminate all this risk for both the borrower and the builder. Now, construction loans are usually either a one-time close or a two-time close. So I'm going to talk about each of those separately and talk a little bit about the features and benefits of both. A one-time close, as the term suggests, requires you to only close in escrow one time. You go to closing before the project starts, you close, and then when the project's complete, you modify into the terms of your permanent mortgage. The other thing about a one-time close is because you're closing before any work starts on the property, your interest rate is locked in at that point. So you don't have any exposure to rates going up as the home is getting built. Some of the disadvantages of a one-time close are that since the lender is taking the interest rate risk and not you, remember your rate is locked, that lender is probably going to charge you a slightly higher interest rate to offset some of that interest rate risk. The advantage of a two-time close construction is that the lender doesn't have any interest rate risk, so you're going to have a slightly lower interest rate on that type of loan. But the disadvantages of the two-time close are that the customer now has all the interest rate risk. So if rates go up while you're waiting to get your house built, then you have that risk. And they usually have higher closing costs because you're not just closing in escrow once on the front end, you're closing once on the front end, and then when the project's complete, you're going back and closing on your permanent loan. We find that people generally want to do a one-time close and lock in their interest rate up front and not have the risk of those rates going up while the house is getting built. Now, the other thing to remember about construction loans is that no matter who the lender is, all construction loans are typically going to have a little bit higher closing costs. The reason for this is because there are additional inspections, there's additional admin work that the lender has to do. They have to administer all the construction draws, pay the contractors, check the licensing. There's additional title work that the title companies have to do on a construction loan. Now, this is the reason also that most banks and mortgage lenders don't do construction lending. They just simply aren't staffed for it or don't have the expertise. So it's important if you are exploring the option of a construction loan that you seek out a lender that has knowledge and expertise in this area. The additional cost of the construction loan, remember, offsets the builder risk and borrower risk that we talked about earlier, because you don't want to get down to the end of that construction period and something happens and you can't close on the loan and now you've got a house built on your property and no way to pay the builder for it. So a construction loan really eliminates that risk for both the builder and the borrower. Thanks again for letting me talk to you a little bit about construction lending today. If you'd like more information, you can go to our website at www.countryplace.com www.countryplaceloans.com. Again, that's www.countryplaceloans.com. Thanks again, and we'll talk to you soon.